What if I told you that most traders are using volume profile completely backwards? They see a high volume node and immediately think price will bounce here. They see a low volume node and think price will reject there. And that's exactly why they keep getting trapped. The truth is, volume profile isn't just showing you support and resistance, it's showing you something much more important: where the market considers price fair and where it considers price unfair. Once you understand that distinction, you'll start seeing market structure in a completely different way. In this video, I'm going to break down the biggest misconception traders have about volume profile, explain how institutions actually use it, and show you a practical framework you can apply immediately. Let's get into it. Most traders learn volume profile like this: high volume nodes, POC, value area highs, value area lows, equals lots of volume traded there, so when price touches it, they enter a trade. The problem is, that's not what volume profile was designed to show. Volume profile measures how much business was conducted at different price levels. Think about it like a real estate market. Imagine a neighborhood where thousands of homes are bought and sold every year. That tells us buyers and sellers generally agree on the value of homes in that area. Now imagine another neighborhood where almost nobody wants to transact. Prices move through quickly because nobody sees value there. The market works exactly the same way. Volume profile is showing us where buyers and sellers agreed, where buyers and sellers disagreed, where price was accepted, and where price was rejected. To understand volume profile, you need to understand one concept. The market is an auction. The sole purpose of an auction is to find fair value. Think about an auctioneer selling a painting. If nobody buys it, he lowers the price. If everyone wants it, he raises the price. Eventually, a price is found where both buyers and sellers agree. That's called value. Financial markets operate the same way every day. Price constantly moves higher and lower, searching for value. When value is found, volume increases, trading activity increases, and price slows down. When value is not found, volume decreases, price moves quickly, and the market searches elsewhere. Let's talk about high volume nodes. This is where most traders make their first mistake. A high volume node is not simply support. A high volume node is an area of acceptance. The market spent a lot of time there, a lot of contracts traded there, a lot of buyers and sellers agreed there. In other words, the market believes this area is fair value. Think about what happens when price returns to fair value. Do we usually see explosive moves? No, we usually see rotation, back and forth movement, consolidation, because both buyers and sellers are comfortable transacting there. This is why high volume nodes often act like magnets. Price tends to gravitate toward them, not because they're support, but because they're areas of accepted value. Now let's look at low volume nodes. These are the opposite. Very little trading occurred there. Very little agreement occurred there. The market moved through these prices quickly because participants viewed those prices as unfair. This is why you'll often see explosive movement once price enters a low volume node. It's not because the level is magical, it's because historically there wasn't enough interest to keep price there. Low volume nodes are areas of rejection and imbalance. Here's how professional traders typically think. Instead of asking where is support, they ask, is the market currently accepting or rejecting price? Let's imagine price breaks through a value area high. Most retail traders immediately buy. Professionals wait because they want evidence that the market accepts higher prices. If volume starts building above the high, that signals acceptance, which is bullish. If price quickly falls back into the value area, that signals rejection, which is bearish. The focus isn't on the level itself, the focus is on the market's reaction to the level. Volume profile becomes a decision-making framework rather than a collection of lines on a chart, and that's where the real edge comes from. Here's a simple framework you can start using immediately. Mark out the value area high, value area low, and POC of previous week, previous day, overnight, and developing New York session volume profiles. Ask yourself, how have the value areas moved? How are the POCs moving? This will help you determine if higher or lower prices are being accepted. For example, if the current New York session value area is holding above previous day's value area, this is a sign higher prices are being accepted. Step 2. Watch for acceptance or rejection. When price reaches these areas, do not immediately enter a trade. Instead ask, is the market accepting this price or rejecting this price? Watch the volume and time spent at this price. the answer often determines the next major move. If you remember only one thing from this video, make it this. Volume profile is not a support and resistance indicator. It's a map of market acceptance and market rejection. High volume nodes show where value is accepted. Low volume nodes show where value is rejected. Once you stop treating volume profile like a collection of lines and start viewing it as an auction market tool, you'll begin seeing opportunities most traders completely miss. And that's why 90% of traders misunderstand volume profile. Not because it's complicated, but because they're asking the wrong questions. If you found this video helpful, hit the like button and subscribe, and let me know in the comments, do you currently use volume profile, or is this your first time learning about it? Thanks for watching, and I'll see you in the next video.